Welcome to Subramani. Here is a very interesting question which a reader, viewer has asked. I am not naming him or her, but the query is interesting, so I'll just read out the query and then answer it. It's going to be perhaps be a longish video. But she starts by asking, if one looks at the years running from 1995 to 2002, there were several years of negative Sensex returns. And even the horizon from 1991 to 2002 was quite depressing on an annualized basis. You have made references of this several times. While in 2008 and 2022, I think she means 2020, recoveries were quicker. This kind of sustained 10-year bear market phase is quite daunting for planning. I think she got some of the numbers wrong. It is not 1991 to 2002, because 91-92 was a boom. 91 was the market did well, 1992 was Harshad, so 93 to 2002 is correct. So her numbers, little bit of correction. So, and then the question follows. My question is, how do you manage such a sustained long drawn bear market phase, especially if we had goals planned during that period? What would an investor in 91 to 95 have done if they had goals in 2002, especially if he was starting in his mid 1990s and had a child's higher education in 2002 or something like that? I would like to hear your guidance for understanding below as potential approaches. So she has given her approaches: more active management through the right selection of funds and stocks, assuming active management will give superior returns and could have been better returns. I am yet to collate returns of funds during that period. More active management would have helped with some reasonable international diversification. Do nothing and just continue with your SIPs with the hope that 2004 things would give better results. Operate with mindset and plan in such a way that equities at 10% CAGR is preferable after 10 years. And while you have trust in equities and continue to take risk for longer tenure goals. However, for goals which are 10 or 15 years, ensure that there is enough debt component. For goals higher than 10 years, you take a plan B, especially for goals like education. Would like to know your views on this. Okay, so this is a nice long comprehensive query. Query itself has taken about 3 minutes. So I made some corrections in the date. So one thing which happens is, if you go even prior 1979 to maybe 2002, market was a longish bear market with spurts of teji. For spurts of teji in the sense spurts of bull market. People like Harshad Mehta came and played the market and took it to dizzying heights in 1992. 1977-78 was a time when a lot of mega IPOs of 60 crores or 600 crores and all would come, and that would be considered to be mega issues because nobody thought that they could raise so much money from the market. It was Dhirubhai Ambani who taught people that, look, market is a place for raising money. So that was the beginning of the capital market, I would think sometime in the 70s, even though markets are much older. So what does one say to such a query? First of all, I agree with you that markets can be in a bear phase for much longer than we want it to be. We want it to be in a bear phase maybe for 2-3 months and then things would recover. It does not always have to happen that way. And even here, you are very clearly or say very smartly playing the 10-year game, saying 10 years market could be in a bad shape. Why not 15? Right? So why have markets shut down? You have to know that Russia also had an equity market, right? 1919 just shut down. So those kind of risks are there. So what are the biggest risks? The biggest risks are there being no democracy for a long period. Let's suppose there was a Bangladesh stock market, right? What would have happened when there is a coup like this? Your money is stuck. We don't know how long. So that is one risk which can happen. In India, you are hoping that such a thing won't happen. So the most important thing for managing your portfolio is going out there and voting for the right party. Whatever is your decision, but go and vote. Don't take a vacation and not go and vote. Also, it is important to know that you are talking about a theory. I have lived through this period. I started investing in 79, but 91, 92 is the time when I was, 92 was the time when I was 30 years old. So which means that was the starting time of my life in investing and a career in investments, which means I was a stock broker at that time. And 93, right? 93, the NSE, SEBI, all of them came at that time. So one more thing which she has said is, I have not seen what returns funds gave. There were no great funds, right? 1993 was the entry of the private sector fund. Earlier it was only US 64. So it was, you were either in the market or you were not in the market. You could not have been in the market through mutual funds and ULIPs, etc. There was only LIC, and LIC was investing in government debt. So that was there was not much of retail money through vehicles like mutual funds or insurance companies. So I don't think also in the 1990s the concept of I've kept this money for my daughter's wedding in equity or my son's wedding for his education or things like that in equity was not happening. That was a time when people had money more in fixed deposits for weddings and education, or they had land. They'd say, oh, I bought 2-3 pieces of land, one I sent for my son's education, one for my daughter's education, one for my daughter's marriage. That is how more planning was done. People like me, I mean, there were many people like us. It's not that I was alone. We are all people who benefited from the 1977, I mean, my father, from the 1977-78 when George Fernandes drove out the FERA company. So we had all bought those shares. Those shares didn't fall so much during this period. You really saw good quality companies not falling so much. So you could hold on to good quality companies, you could get dividends, those things could happen. Also, you have to remember there were times when Indira Gandhi just froze the dividends. So Hindalco couldn't pay dividends for 10-12 years. I think that she had steel and aluminium price control. So which means those companies would have just been doing so badly that even if you were a shareholder, you were not getting dividends, you were not getting anything. Would you have had the patience to sit through that? That's the first question to ask. Secondly, I think there is nothing called long term, short term in equity. Equity, you should be able to own open ended. You don't have money in equity for a particular goal, and if you have it for a particular goal, you should know how much to withdraw and how much in advance. For example, if you have a goal which is happening in 2027, I would start withdrawing now, or I would withdraw a big chunk and put it into some gilt fund saying it by 2027 I will withdraw. I cannot take a risk of 2-3 years. Another thing which has happened is the governments, whether it is the US government, whether it is the Fed, whether it is RBI or Narendra Modi government, doesn't matter. I don't think they have the ability to take real tough decisions. So if the market is in a smallish recession also, maybe 3 months, the market doesn't do well. Remember, India is a country of elections. So some election would be coming up, UP, Bihar, Tamil Nadu, Maharashtra, Bengal, all these places have large number of seats. So the central government will do anything to keep its place. So they may make dividends tax free, or they may abolish long-term capital gains, something like that they will do. It may hurt the country, but it will look like a sop to the equity players. So therefore the equity markets could revive. Another thing which could happen is you might panic yourself and say, oh my God, this is too bad, and so I'll sell. It's not a question of reading in a book or hearing in a video what you should do. I have many videos saying how you should handle these falls, and I'm not calling them 10-year recessions or things like that. So some shares you will sell, some you will sit in some cash. Right now I've been selling quite a bit. not as aggressively as some of my friends, but I'm not so keen to be in the market at the top. I'm very happy going away somewhere near the top, right? So is the market at the top? Well, that's my view on some of the shares which I have bought, which have gone up 7 times, 8 times, which to me is enough, simply because I don't see great value there. So somewhere when you don't see much value, you may have to sell. Secondly, the skill is not just sitting through this recession of bad times from say 1992 to 2002. It's a question of what do you do from 2003 onwards, right? So 2003, suddenly you see the index is from 3000, it has gone to 6000. It is hugely tempting to sell off whatever you have, right? So that is another huge temptation, and that is bound to happen. Sitting through those times are also difficult. So if you need immaterial of size of portfolio, let's say you need 50 lakhs in 2027 and we are in 2024, and you have a largely mid cap, small cap kind of a portfolio, I would suggest that you start withdrawing if you got 50 months to go, right? So 4 years to go, or I would start withdrawing 1 lakh per month right now for that goal, and putting it into a maybe in a gilt fund, or maybe even in a ultra short bond fund, or a short term income fund. I would not mind doing that, simply because I don't want to take the duration risk, nor do I want to take equity market risk. And if I have a, let's say I have a very big portfolio, let's say I have a 10 crore portfolio and I need 50 lakhs, I'll just ride it and I'll say it doesn't really matter. My 10 crore portfolio can become 5 crores. I can still withdraw 50 lakhs without worrying too much. So some portion will continue to be in equity because I'm already withdrawing in installments. Some money would be in debt funds, and these are some of the things that I would do. Now this is again in theory. Practically what you will do is more important than what I say you must do. So play it accordingly, and then maybe a little bit of international diversification, saying okay, some money can lie in foreign rights. It can lie in foreign, when I say REITs, I mean REITs, REITs. It can lie in gold, it can lie in debt, it can lie in mid cap, small cap, large cap combination, multi cap funds, flexi cap funds, balance advantage fund, where you let the fund manager do the portfolio sizing and portfolio allocation, how much in debt and how much in equity. So all these combinations will help. What exactly will help you have to see. And also the answer is going to be very different for a person who is in equity and for a person who is in equity mutual funds. In equity mutual fund, I think shifting some part of your money to balance advantage fund, which I've done, which I've suggested for many people, is to say, okay, you think the market is high, put some money in balance advantage fund. The fund manager will do the asset allocation according to the market. I hope I've answered your question. Thank you.